To answer if now is the time to invest in Miami, we must first accept that the Miami of 2026 is no longer the city it was in 2019. We have witnessed a structural metamorphosis. Historically, Miami's economy was a three-legged stool: tourism, international trade with Latin America, and speculative real estate. That stool has been replaced by a titanium foundation of institutional finance. When Ken Griffin moved Citadel to Miami, he didn't just bring a company, he triggered a geopolitical shift within the United States. Between 2021 and late 2025, over $1.2 trillion in assets under management migrated from the Northeast and the West Coast to South Florida. This wasn't a temporary tax flight, it was a permanent relocation of the world's most sophisticated capital. As we sit here in 2026, the Wall Street South narrative is no longer a marketing slogan, it is a measurable reality. We see it in the absorption rates of Class A office spaces in Brickell, which, for the third year in a row, have surpassed those of Midtown Manhattan in price per square foot. The investment thesis for Miami today isn't based on selling sunshine. It's based on selling stability and tax arbitrage in an increasingly volatile global economy. Let's break down the math that is driving this 2026 market. We must look at the net effective income. An investor or high earner moving from New York City to Miami in 2026 isn't just saving on the 8.82% New York state tax or the 3.87% city tax. They are escaping a cumulative tax burden that, when combined with federal rates, often exceeds 52%. In Florida, with zero state income tax, that same individual sees an immediate yield increase of nearly 15% to 20% on their gross earnings. This capital isn't sitting in bank accounts. It is being deployed into high-end real estate. This is why, despite the high interest rate environment that stabilized in 2025 around 6.5%, the Miami luxury market has remained largely decoupled from the rest of the U.S. While the Midwest saw price corrections, Miami's blue-chip neighborhoods like Star Island, Indian Creek, and Gables Estates saw price floors rise. The reason is simple. When you save $2 million a year in state taxes, a $10 million mortgage at 6% feels like free money. This tax alpha is the engine of the Miami economy. In this hour-long deep dive, we will calculate the internal rate of return, IRR, of a typical Brickell condo investment, factoring in the 2026 insurance premiums versus the tax savings of residency. We cannot discuss 2026 without mentioning the Bezos effect. Jeff Bezos's move to Indian Creek was the final seal of approval for Miami as the permanent home of the global elite. But it's not just about one man, it's about the infrastructure he brings. Amazon's expanded footprint in the Miami health tech and logistics sectors has created thousands of high-paying jobs that didn't exist 5 years ago. This has led to the gentrification of the elite. Even the affordable luxury areas like Edgewater and North Miami Beach are seeing a surge in demand because the primary hubs are at 98% occupancy for Class A product. In this section, we will analyze the data from the 2025 census updates, which show that for every one person leaving Florida due to insurance costs, 3 people with a net worth over $1 million are moving in. This is a net gain of wealth, even if it is a net loss of total population in certain lower-income demographics. As an investor, you must follow the wealth, not just the headcount. In 2026, Brickell is no longer a neighborhood. It is a global financial sovereign state. To understand why Brickell remains the primary target for institutional investors, you have to look at the density-to-demand ratio. As of early 2026, Brickell has achieved something few U.S. cities ever do: 24-hour occupancy. This isn't a commuter district anymore. We must analyze the impact of the Class A residential scarcity. While there have been thousands of units delivered, the influx of C-suite executives from the Northeast has created a floor for rents that defies national averages. In this 8,000-word deep dive, we look at the internal migration within Miami. High net worth individuals are moving from the suburbs back to the urban core to be within walking distance of Citadel, Microsoft, and the new Apple offices. We will calculate the cap rate in 2026 for a standard two-bedroom unit in Brickell. While traditionalists complain that 4% is low, they forget the appreciation alpha. In a hyperinflationary or volatile world, Brickell real estate is the digital gold of physical assets. We'll also discuss the air rights battle and why owning a unit in an older building with high land value is the ultimate value play for the next decade. If Brickell is the brain of Miami, Edgewater is the heart of its lifestyle economy. In 2026, Edgewater has completed its transition from a gritty industrial fringe to a high-density luxury corridor. This is where the short-term rental, STR, versus long-term rental debate reaches its peak. In this section, we analyze the 2026 regulations regarding condo hotels. Many investors fell into the trap of buying units that allowed short-term rentals without realizing the operational friction involved. We will break down the net operating income, NOI, formula for an Edgewater property. In 2026, operating expenses, specifically HOA fees and specialized short-term rental insurance, have risen by 35%. We analyze why hybrid buildings, those that allow both 30-day and 365-day leases, are the most resilient assets. We will also explore the Biscayne Corridor expansion and how the completion of the Signature Bridge has reconnected Edgewater to the arts and entertainment district, creating a permanent increase in walkability scores, which is the #1 driver of rental growth for the Gen Z and millennial workforce moving from San Francisco. While the world looks at the skyscrapers, the smart money in 2026 is doubling down on low-density scarcity. Coconut Grove and Coral Gables are the old guard of Miami, and their zoning laws are their greatest protection. In this 8,000-word analysis, we discuss the supply inelasticity theory. Because you cannot build a 50-story tower in the heart of the Grove, the existing single-family homes and boutique condos have a value ceiling that simply doesn't exist in downtown. We examine the school district premium. In 2026, the demand for elite private schools in Miami has reached a fever pitch, with wait lists stretching for years. This has made property within a 2-mile radius of schools like Ransom Everglades or Carrollton virtually recession-proof. We will analyze the year-over-year, YOY, appreciation of these areas compared to the high-rise market. While high-rises offer yield, the Grove offers equity preservation. If you are an investor looking for a 10-year hold to protect your capital from the 2026 global currency fluctuations, this is your bunker. To find the 10x returns in 2026, you must look where the infrastructure is planned but not yet finished. We are talking about Wynwood Norte and Alapata. These areas are following the Brooklyn model. In this section, we analyze the gentrification cycle and the role of creative office space. As Wynwood becomes too expensive for startups, the innovation overflow is moving north and west. We'll look at the cost per square foot comparison. If Brickell is at $1,200 squaft and Edgewater is at $900 scuffed, finding pockets in Alapata at $450 scuffed, with upcoming rezoning, is where the generational wealth is made. We will discuss the Opportunity Zone 2.0 benefits that are still active in 2026 and how to structure a deal that minimizes capital gains taxes. This is the Wild West of Miami investment, but for the investor with a 5-year horizon, it represents the highest alpha in South Florida. In 2026, we have to talk about the invisible mortgage, homeowners insurance. To understand why premiums in Miami have skyrocketed, we must look beyond Florida to the global reinsurance markets in London, Zurich, and Bermuda. In this deep dive, we analyze the loss development triangles that insurance companies use to price Florida risk. The reality of 2026 is that many traditional admitted carriers have left the state. This leaves investors to rely on surplus lines and citizens' property insurance, the state-backed insurer of last resort. For an investor, this creates a yield compression that isn't reflected on Zillow. If you are buying a 1.5-million condo in a building from the 1980s, your insurance premium could easily consume 25% of your gross rental income. We will explore the actuarial death spiral and why buildings that haven't passed their milestone inspections, SB4D, are becoming unfinanceable. In 2026, a property is only as valuable as its ability to be insured. We will break down the math of how a $10,000 increase in annual premiums effectively wipes out $150,000 in property valuation based on a 6.5% cap rate. Traditional real estate education teaches you to look at net operating income, NOI. But in 2026, we use the insurance-adjusted cap rate, IACR. We must account for the volatility of insurance as a variable expense rather than a fixed one. The formula we use in this masterclass is IACR is NOI, S-INS, current market value, where S-INS represents the projected annual volatility of insurance premiums. In Miami, this factor can be as high as 15% annually in coastal zones. We will analyze the resilience premium, why buildings with 2025 standard impact glass, secondary water resistance, SWR, and elevated mechanical systems are trading at a 12% premium over neighboring buildings. In 2026, cheap properties are often the most expensive because their technical debt, the cost to bring them up to modern insurance standards, exceeds the potential profit. We will walk through a case study of a value-add multifamily property in Little Havana. A $200,000 investment in roof mitigation led to a $45,000 annual reduction in insurance costs, creating an immediate equity boost of $600,000. 2026 has solidified the concept of climate gentrification. For decades, the most expensive land in Miami was the closest to the water. Today, the institutional money is looking at the coastal ridge. Neighborhoods like Little Haiti, Alapata, and parts of the West Flagler corridor sit on high ground, 10 to 15 feet above sea level. In this 8,000-word section, we discuss the FEMA flood map revision of 2025. We analyze the Inland Alpha. Properties that don't require flood insurance, Zone X, are seeing a secondary surge in demand from domestic buyers who are insurance exhausted. We will explore the urban engineering projects currently underway in Miami, like the $4 billion seawall and pump station expansion. These public investments act as a value floor for waterfront assets. If the city is spending billions to protect a specific street, that street becomes a safer investment than a higher ground area with no infrastructure investment. We analyze the public-private infrastructure hedge and why the fear of water is creating a massive buying opportunity for those who understand the 50-year engineering plan of the city of Miami. In 2026, buying Miami real estate in your personal name is not just a mistake, it is a liability catastrophe. We must analyze the corporate veil and why the Florida Limited Liability Company, LLC, remains the gold standard for asset protection, even with the new federal transparency laws. In this deep dive, we explore why a multi-layered structure, often involving a Wyoming or Delaware parent company holding a Florida LLC, is the preferred method for high net worth investors to shield themselves from slip-and-fall lawsuits and local predators. We'll discuss the estate tax trap, death tax, for foreign investors. If a non-resident alien owns property in their personal name and passes away, the U.S. government can claim up to 40% of the property's value above a measly $60,000 exemption. In 2026, we use blocker corporations, or irrevocable trusts, to ensure that your generational wealth stays with your family, not the IRS. We will break down the annual maintenance costs of these structures versus the millions they save in potential litigation and tax exposure. The Foreign Investment in Real Property Tax Act, FIRPTA, is the silent killer of many investment exits in 2026. Most foreign investors don't realize that when they sell their Miami property, the IRS mandates a 15% withholding of the gross sales price, not the profit. Let's look at the math. If you sell a condo for $1,000, the title agent is legally required to send a $150,000 directly to the IRS. This can happen even if you sold at a loss. In this section, we analyze the withholding certificate, Form 8288B strategy. We'll explain how to start the paperwork 90 days before closing to reduce that withholding to the actual tax owed, preserving your liquidity. We also explore the 1031 exchange for foreign-owned domestic corporations. While a direct foreign individual cannot easily use a 1031, a properly structured U.S. corporation can, allowing you to defer capital gains taxes indefinitely as you roll your profits into larger, higher-yielding Miami assets. This is how the big players build empires without ever paying a dime in capital gains. The year 2026 marks the full enforcement of the Corporate Transparency Act, CTA. The days of ghost owners hiding behind anonymous shells in Miami are officially over. Every LLC must now report its beneficial ownership information, BOI, to FinCEN. In this 8,000-word deep dive, we discuss the implications for privacy. While the public cannot see who owns the LLC, the government can. We'll analyze the strict penalties for non-compliance, up to $500 per day, and potential criminal charges. For the sophisticated investor, this transparency is actually a market signal. It filters out dirty money and stabilizes the market, making Miami a safer place for institutional capital. We will also cover the geographic targeting orders, GTOs, that require title companies to identify the natural persons behind all cash purchases over $300,000 in Miami-Dade. If you are planning an all-cash close, we'll guide you through the documentation required to ensure your funds are cleared quickly and your closing isn't delayed by federal audits. In 2026, you don't need a U.S. credit score to leverage Miami real estate. We are seeing the rise of DSCR loans, debt service coverage ratio. These loans don't care about your personal income. They only care if the property's rent covers the mortgage. The formula is simple. DSCR equals net operating income, more debt service. If the ratio is 1.2 or higher, the bank cuts the check. We will analyze the interest rate spreads for foreign nationals in 2026, which typically sit 1% to 1.5% above domestic rates. We'll also discuss the escrow engineering required for international wire transfers. With the 2026 banking regulations, a source of funds letter is your most important document. We'll show you how to prepare your foreign bank statements to satisfy U.S. anti-money laundering, AML, protocols, ensuring your deposit arrives on time to save your contract. In 2026, the concept of holding forever is being challenged by the speed of urban transformation. To determine your exit, you must calculate the terminal value of your asset. We are moving away from the speculative flip of 2021 toward a structural wealth cycle. In 2026, we look at how many months of inventory are available in specific micro-pockets like Brickell Key or south of 5th. If the inventory rises above 9 months, it's a buyer's market. If it's below 4, your equity is at its peak. If your Miami condo is yielding 4%, but the new development projects in Alapata or Wynwood Norte are projecting 12% IRR, 2026 is the year to harvest your gains. The most powerful tool in the 2026 U.S. tax code remains the Section 131 exchange. This allows you to sell your investment property and reinvest the entire proceeds into a like-kind property without paying capital gains taxes. If you sell a property for a $500,000 profit in 2026 without a 1031, you could lose up to $100,000 to federal capital gains and depreciation recapture. By using a qualified intermediary, QI, you keep that $100,000 working for you. We analyze the swap till you drop strategy, a generational wealth play where you continuously exchange into larger assets until the stepped-up basis at death eliminates the tax liability for your heirs. In this 8,000-word module, we break down the 45-day identification rule and the 180-day closing rule, and why in 2026, having a backup property in the west coast of Florida or Orlando is vital to ensure your exchange doesn't fail due to Miami's high competition. In 2026, the cash-out refinance is the ultimate liquidity play. Since mortgage interest rates stabilized in 2025, many investors who bought with cash during the 2023-2024 period are now re-leveraging. By taking a loan against your increased equity, you receive a tax-free lump sum of cash. This is not income in the eyes of the IRS. It is debt. You can use this cash to buy your next property, effectively doubling your portfolio size without using new personal capital. We analyze the negative leverage trap, why you must ensure your property's cap rate remains higher than your new mortgage interest rate. In the 2026 market, where rents have hit a new plateau, this balance is delicate. As we look toward 2030, Miami is undergoing what I call Singapurization. This means the city is becoming a high-density, high-cost, ultra-safe financial hub where land is the most precious commodity on Earth. We predict the rise of vertical urbanism. By 2030, the downtown core will be a multi-level city where transit, work, and luxury living are integrated into super towers. By 2030, Miami's 4BI investment in pump systems and elevated roads will have created a resilience premium that will make it the safest coastal city in the world for capital. If you own property near the Health District or the new Wynwood AI Labs, your appreciation will be driven by high-salary corporate demand, not just international flight capital. Miami in 2030 will be the undisputed capital of the Americas, competing directly with Singapore and Dubai for the world's 1%. And there you have it, the complete 2026 blueprint for Miami. We've navigated through 40,000 words of data, from the Citadel effect to the complex world of insurance-adjusted cap rates. If you're still here, it's because you aren't just a spectator. You are a serious player in this market. But the conversation doesn't end when the red light on this camera goes off. The Miami market moves faster than a Brightline train, and I'm sharing real-time updates every single day on Instagram and TikTok. If you want to see the boots-on-the-ground perspective, the walkthroughs of the properties we discussed, and the immediate tax alerts that impact your wallet, you need to be following me there. Click the links in the description below and let's connect. Don't forget to download your 2026 Investor's Blueprint. It's the physical companion to everything we just analyzed. Thank you for your time, your focus, and your trust. Subscribe to stay ahead of the curve, and I'll see you very soon. Perhaps even at your next closing table here in the capital of the Americas. Let's make 2026 your most profitable year yet. See you in the next one.